from Brisbane, our next caller. Hi there, Timmy, and thanks for waiting.
Hi, Nita. Just got a question for Roger in regards to MMS, McMillan Shakespeare.
Oh, yeah.
I know he's a big fan of it and spoke about it quite a lot last year, but it's had a big price drop, and just want to know if it's still on his radar or he's buying more.
Right. Yeah, okay. Well, I wrote on my blog that when I actually sold the stock at $3.97.
What happened in January to cause this tumble?
There was some
Roger sold out.
Yeah, true. That's my selling. No, it's not really. It's not. I sold, and I wrote about it on my blog what happened was Anthony Podesta sold some shares. He's the founding shareholder, and he sold a substantial swag of shares. Coming as that sale did months before the release of Ken Henry's tax review, which could have an impact on the business of McMillan Shakespeare. It's in the business of salary packaging. It's doing it for charities, and it's doing it, FBT's an issue. We just don't know what the Ken Henry tax review has. So when Podesta sold some shares, my experience as a fund manager has just been, it doesn't smell right to me. Now, it might be innocuous, it might not be an issue, but I just don't like it. So I said, I'm going to sell my shares as well. I sold them at $3.97, and I said on my blog, I'm just going to sit this out. And then the share price tanked. Now, no one was able to predict that, and I think it was on fear of what's coming out of the Ken Henry tax review. But what people need to understand is that nobody knows what's in it yet, in any detail, and once it's released, you don't even know if the government's going to adopt any of the recommendations. So let me say this, if the Ken Henry tax review comes out and it's benign for Macmillan Shakespeare's business, then it is cheap. And it's a good business, it's got great cash flows, high return on equity, no debt, just an amazing business. If, however, the worst case scenario were to eventuate, well, half of Macmillan Shakespeare's business is gone.
Well, you see, there's a lot of buts and ifs then, aren't there?
Well, that's it. That's why I say I'm sitting it out. I'd rather wait and see. Too much uncertainty. Look, I've had people say to me, the game's up with, for Macmillan Shakespeare, and I've had other people say there's no way that the government will adopt changes that are going to drastically reduce the dollars in the pockets of people who are working at charity organisations, which Macmillan Shakespeare does some work with. So, there's two sides. I'm in the fortunate position of having sold my shares at a much higher price, so I can look at this with some objectivity. All I can say is I don't know what the outcome is. I think it's cheap if everything turns out okay.
If everything turns out okay.
Exactly.
Yeah.
And all the comments that Jeremy's made about, about relying on a legislative environment that's favourable, it all remains. That's the case.
Well, time will tell what's in store for the Henry tax review and indeed for Macmillan Shakespeare. Our next caller, Jason in Brisbane, who's been waiting patiently. Hi, Jason.
Hey, how you going?
Good, thanks.
Just from the panel's opinion on the company Austin Engineering, code ANG. Thanks.
OK, we'll get the chart up on the screen. Austin Engineering currently trading at $2.82, up by about 6 cents today, Jeremy.
Yeah, look, it's a good stock. It's a better stock because of an interest taken in them by Bradken, who bought a stake of about 5 or 6%. And it was only a week ago. So Bradken's a substantial company of its own right, and their interest, which we're not sure where it's going exactly, whether it's going to be a greater interest. It's strategic at 5%. It doesn't strike me that Bradken would simply want to be a strategic investor in Austin, and they may have greater designs.
No. Bradken are an acquisitive company, and if you look at their history over the last half a decade, you'll see that they've debt funded and equity funded acquisitions, and that's how they've grown. The last result that came out for Bradken was actually the first one where I thought, well, now we can see what the business generates in terms of cash, because they actually generated some cash. They didn't go, they didn't muddy it all with acquisitions again. But here they go again.
It's in their nature.
Yeah, exactly. Yeah. The leopard can't change its spots. No. Bradken for me is not a business that, compared to the other things that are available, is something that I would look at. And so, if I was an Austin Engineering shareholder, I'd want to have a lot of information about why they think it's going to be an acquisition that is going to make sense for shareholders, if that's what they do.
Stephen from Leichhardt, you're up next. Hi there.
Hi. I was just wondering what the panel's views were, and particularly Roger's valuation on McMahon Holding and Asciano. Thanks.
Okay, McMahon Holding.
Asciano is one of yours this
Yeah,
week.
I wrote about Asciano only on the blog I think a Monday or the weekend.
And there's a chart on the screen. AIO is the stock code.
I just can't believe that people pay the prices they pay for this thing. It just beggars belief. It's got so many competitive issues. It's going well in Queensland Rail, but now we've got the Queensland state government about to privatise Queensland Rail, so there's going to be a bigger competitor. Queensland Rail owns all the track. If they privatise it, Queensland Rail could do a Telstra on this company, and so as a result, I'm very, very concerned about that. Having said that, Asciano is winning some decent coal transport contracts in Queensland, so that's good. But I can just see if you've got Queensland Rail privatised and they own all the trains and they own all the tracks, then it's very easy for them to charge a very high rate for other companies to use their track network and then use that money to subsidise a lower rate offering for their trains to win customer business. Then in Melbourne, on the wharves, they've got potentially a third operator coming in, which is going to hit them there as well. It's just a look. I really think if you live on an island, you want to own the access to all the ports. It's a great concept, it's where all the freight comes in. It's great. But this business doesn't have a return on equity that justifies its price, and its value is considerably lower than its current price.
Our next caller, Tony from the Central Coast. Hi, Tony.
Yeah, how are you going?
Very well, thanks for calling in.
No worries. I just wanted to ask you about Regional Express and Fosters, and just the panel's thoughts on those two stocks, please.
Okay, we'll start with REX, R-E-X, Regional Express. Of course, this is as the name would suggest, a regional airline, and currently at about $1.35.
Roger loves airlines.
Oh, mate, don't I love airlines, Jeremy? You know me well. I don't like airlines.
Just to clarify.
Do you want me to just express that again? But this particular airline is an anomaly. I'm still not going to buy it, right? But it's an anomaly because it's the only airline that flies on certain routes, and so it can theoretically charge whatever it likes if people want to get there by plane. That's a position that not many airlines in the world are in. In fact, most airlines are in precisely the opposite position, where they're now charging 1 cent for a flight. It's just bizarre behaviour. In fact, it's cheaper to fly to Melbourne now than it is to ride a bike, because you'd have to replace your tyres and you'd have to eat. And it's far more expensive to ride your bike down to Melbourne.
And have some water.
Look, so Rex is an anomaly. If you're going to own any airline in the world, and I can't believe I'm saying this, Rex would probably be the one, but I'm not going to buy it. And the accounting for airlines is atrocious. It really is. The accounts do not reflect the economic reality of airlines. They've got this item in there called depreciation, which is based on the historical cost of the planes. And what that means is, and the planes have a 20-year useful life in some cases, so the expense that they're attributing to owning that aircraft and replacing that aircraft is based on what it cost to buy the plane 20 years ago, potentially. And clearly, buying a new plane today is going to be much more expensive. So if we do our own little sort of accounting gymnastics and we got rid of depreciation, we put in some sort of a provision to replace the planes, that number would be much larger and the profit would be much smaller. And what was the other company again?
Fosters.
Fosters is a business that I still think has some intangible assets on its balance sheet that are unjustified, and it's got some goodwill in there as a result of overpaying for Southcorp many years ago, paying 3 or 4 times too much for it. And so I think there's the risk that there's more write-downs there to come. We've got a wine lake, and it's very cheap now to buy wine, and there's not a lot of money in supplying it. Its low return on equity is a function of the fact that the equity is too high. Why is the equity too high? Because the assets are too high. Why are the assets too high? Because there's all this goodwill sitting there that shouldn't be there, because it's not justified by the returns that are being generated. So that tells me that at some point in the future there's a potential for even more write-downs on top of the $1 billion of write-downs that we've had already.